We need to get a couple ferns. Set up.
It's already been done.
I know,
Like cactuses
I
or
know.
something.
Oh yeah,
Something spiky.
a couple cacti.
Couple cacti. These markets aren't all earning gains.
Welcome to the Whitehawk Wealth Town Hall meeting, our first meeting of 2023. I'm JD White.
I'm Cameron Dye.
And we are very happy that you're able to join us today. A lot of snow on the roads. If you're driving today, drive safe. I borrowed my wife's car to get into the office. Cam's got a big truck, so we're good. And as most of you know, we're natives, so no strangers to snow. So what's new with Whitehawk Wealth? We are in annual review mode. So doing a lot of annual reviews with our clients, looking at the numbers from 2022. I'm going to have Cam do kind of a market update, but more than anything, kind of look in the rearview mirror. I think we're all happy to close the door on 2022 and start looking ahead at 2023. So he's going to hit on that. I will tell you that we've kind of been honing in on what type of clients we are looking for moving forward. So obviously this doesn't encompass everything. We will, it's all case by case, but we are kind of honing in on, just so you know, people that are within 5 years of retirement, either before or after, typically high net worth clients. We are also really enjoying working with small business owners that are within 5 years of selling their practice. We really like the value that we're adding in that space. And then this has been coming up more frequently, people that have recently lost someone. We've realized that I've been through it recently in my personal life, that we are able to guide those people through the process as much as anything, not only just helping them with the assets, but guiding them through the process. So if you do know anyone that falls into those spaces, we'll take an introduction, keep an eye out, keep an ear out. Our challenge is always getting in front of the right people. You are our best resource for that. So anyway, without further ado, I'm going to kick it over to Cam. So since our last meeting, another CPI report is out. We've got 2022 in the rearview mirror or backup camera if you have one of those, which most of us do. So Cam, what did we see 2022 and what's next?
I wish I knew what was next, but we'll start with what we do know. Numbers out for 2022 were, as we all know, not what we would love to see. Hopefully that is kind of done and dusted. It turned out to be the 7th worst year in S&P history on the stock market side. The 2nd worst year in fixed income, although many would argue probably the worst year because you had treasury notes, long dated treasury notes down almost 25% on the year. So if you had an entire sleeve of 30-year bonds, you're still down 25%. It was just a brutal year, start to finish, and not a lot of places to find cover. As far as numbers go, the Dow was down 8.8, the S&P was down 19.4, the NASDAQ was down 33, real estate was down 28, global developing markets were down about 14%, and emerging markets were down about 17%. The places you could have hid, if you were able, were energy and utilities. Energy finished the year up dramatically, and utilities as well. So kind of those safer, staple assets, value plays. You all have exposure to all of those, or at least most of you do. So it was one of those years where the allocation was both good and bad. We were allocated 60-40 in a lot of cases. And those of you that were, that was just the 2nd worst year in 60-40 history. But we are all in this for the long game. Oftentimes a bad year is followed by a good year. In particular, years where the S&P is down 20%. Oftentimes followed by a year where the S&P is up more than 20%. Now, obviously, down 20, up 20 doesn't necessarily get back to where you started, but certainly heads you in the right direction. And we are seeing a lot of green shoots, if you will. As JD mentioned, CPI was down to 6.5, still very high historically, but that's a heck of a lot less than 9.1, which is where we were like 4 months ago. So you're looking at almost 5 months, I believe, of down CPI. The big contributors this last month in December were energy prices. Gasoline in particular was down 4.5%. That's a big part of it. and 33%, I believe, of CPI. So a third of it is shelter, and that was only up 0.8%. But shelter is by far the biggest lagging indicator, or part of that indicator. And as we've seen, if you follow Zillow or Redfin or any of the people that follow rents in particular, rents have already started to roll over pretty dramatically in a lot of places. So 6 to 9 months down the road, that will actually hit the CPI number. But in the meantime, everything else has either started to roll over or become flat. So I think we are very much expecting a continuation to the downside in CPI numbers. We'll find out in another month or so. And in the meantime, the Fed they didn't have a meeting in January. So their meeting is actually, I believe it falls on the 1st of February. So we'll see what they do. It sounds like they will for sure raise. I think we're all in agreement there. It seems pretty divided between 25 basis points and 50 basis points. And the people that want 50 basis points are trying to make the case that we need to get rates up as high as possible, as fast as possible, and then stop. So sort of the two base cases would be either 25 basis points in February and then again in March, or 50 basis points in February with the hope that then numbers continue down and they stop raising. Retail sales numbers came in today. They were actually down, like well below expectations, which means the average person is slowing their spending. They're trying to plan for whatever's coming next, which is both good for them, but also that sort of means the Fed is getting what they want out of their rate hikes. Mortgage rates have come down some, and the stock market's down, at least this morning, but also the 10-year treasury, which is sort of the guiding light, if you will, within fixed income when it comes to mortgage rates and just general discussions on fixed income markets. That's down almost 3% this morning. So I don't know where it is at this moment, but up until now, it's been down about 3%. So it gives you an idea that maybe the bond market, which is oftentimes considered the smart money, is not necessarily in agreement that the hikes are as impending as the Fed would like us to believe. So that's sort of where things lie there. It's definitely still a waiting game. Inflation must continue to roll over so that the Fed can stop hiking, and therefore we can kind of get on with things. But of the companies that have reported earnings last week so far, 68% of them are beating expectations, which, to be fair, have them lowered fairly significantly. But still, if you beat the expectation, that's generally a good sign. And all the banks that came out on Friday, some of the big guys, came out with solid numbers. Revenue was up in a lot of cases, and they're basically the amount of money they are setting aside for mortgage defaults and bankruptcies and those things haven't gone up tremendously, which is oftentimes a good sign that they're fairly comfortable with where the overall economy is.
Sounds like a whole lot of status quo as far as our economy goes. I think, I'm kind of going through my head all the numbers you gave us. Ugly 2022, kind of going in the right direction. The economy seems to be slowing down. So let's talk about, I'm reading a lot of headlines, as I'm sure everyone here is, about China. So China has reopened back up, which is creating some interesting things. So why don't you hit a little bit on that?
Sure. China in particular, but in general, for what it's worth, the developed markets and emerging markets actually had a really good fourth quarter. I don't know how many of you actually, when you go in and look at your statements, go to the granular level of each fund. But if you were to look at the international markets as well as the emerging market funds that you are exposed to, for the most part, they were up in the fourth quarter fairly dramatically compared to the rest of the portfolio. China is an interesting case because they had the zero COVID policy for so long. It kept crushing manufacturing. It kept supply chains in a bind because every time they would open up, then they'd close again and it would kind of restart the cycle. They've gotten away from that. The numbers, they don't mean all that much because we don't really know the validity of the numbers they're giving. But if they truly are going to go away from this zero COVID idea, that they're not going to close down something anytime one person tests positive, and they're going to try and create herd immunity, now that they do have some exposure to the mRNA vaccines, then the supply chain is in a much better place. The government as a whole has backed off a lot, especially in the tech sector, as far as what they're going to kind of crack down on. Hopefully there will be no more CEOs that kind of go missing like Jack Ma did a couple years ago. And because of that, you're seeing rebounds pretty significantly in a lot of the tech sector in China. The ETFs that follow that, the individual names are doing well. And actually, the US and China is set to break a record for trade, the most trade we've ever done, which is kind of crazy considering the year we just had. But to be fair, that's not an inflation adjusted number. That's a total number. So you got to take it with a grain of salt. But it does mean that for all of the talk of China, Taiwan, China, US butting heads over things, overall, the economy is still kind of just ticking along. And at the end of the day, we both need each other. So I think you're going to see a lot of rhetoric, potential some volatility, but likely just more of a continuation with the status quo. And then we'll see there. And one other interesting point I was going to make was all the talk of England and Europe and the trouble they're having. The British stock market is at all-time highs today. So take that for what it's worth. But I think that we try and really hammer the idea that stock markets in particular are forward-looking. So when you look out the window today and you look at our economy today and exactly where things are, that's not reflected in the stock market. The stock market is trying to reflect what's down the road, 6, 9, 12 months. So that's why we always say that, stock market recovers before the economy potentially does.
Yeah, I'm going to piggyback one thing on that. One thing that I just read today, actually, because I've been complaining, would be the appropriate word to use, about the pump prices going back up. And part of that is with China opening back up, they use a ton of oil for their manufacturing. You think about one of the, you're getting this big engine running again called China, and it's sucking up a lot of oil. Meanwhile, the sanctions from Europe on Russia are kicking in at the same time. So we're creating this pinch in the supply of oil and gas. So don't be surprised if you do see the pump prices go up a little bit on us, even a little bit further here. Hopefully not back up to 5, but we're sitting, I think, on the corner. I think I saw 359, 369 yesterday. So up quite a bit from where we hit. I think I saw 260 at one point. So that explains some of that for if you're wondering why the heck those are going back up. That's part of that. All right, so interest rates. So Cam, talking about interest rates a little bit. This is a question that I've gotten and that I'm hearing a lot on. Are they going to go down this year? Do you think interest rates will come down this year? So,
if I were to place a bet, which I don't on interest rates, I would say yes, although I don't know how significantly it'll be. The idea that the market is priced in a Fed cut at the end of the year, I don't know if they'll get to the point where they cut, because if they're cutting, it's probably because things have actually gone into a recession, things have become worse, and therefore they have to do something. In my eyes, the Goldilocks scenario, the soft landing, if you will, would be more, we get rates to 5, we stop, then the economy takes the rest of the year to sort of digest it. And potentially they come down slightly. Although I think the Fed they have made it clear. Today they came out again and a couple Fed governors came out and just, they keep pounding the table. We are going above 5 and we're going to hold it there for a long time. The market, especially the treasury market, doesn't seem to believe them, but they've this is the hill they're going to die on. So I think chances of them cutting rates is, I don't want to say 50-50, but things are going to have to get bad for them to cut rates, because they're going to have to be incentivized that they have either squashed inflation and now they can, or more likely they basically broke it and they went too far, which the Fed is known to do in both directions constantly. They find the middle is not a place they tend to live. So right. I think there's a good chance you could see the Fed rate stay similar. But if the Fed rate does moderate or potentially come down even slightly, that would be beneficial for mortgage markets, because I think then you're going to see lenders a little more willing to move, because they realize that the market's not going to just continue in this one-way uphill battle. So right. We'll see. But I think the chances are solid. At the least, I think they'll moderate significantly. And right. 5 is kind of where we're going to live.
So ultimately, it'd be bad news for the economy, good news for mortgage lenders.
Potentially. Yeah.
All right. So we don't necessarily want to see the Fed cut rates. We've seen the 30-year mortgage rates come down quite a bit. I think to kind of echo that, I think we're kind of on a flat path here, flat-ish. All right, so I'm going to jump into a little bit of education piece here. I'll start this by saying that I'm going to keep this high level. This is kind of investing 102. So I'm going to assume that everybody on this call or anybody watching this kind of knows the difference between stocks and bonds and that kind of stuff. So what I'm going to talk about is a couple different styles that we use with investing, and we use all of these in our practice. So when we're managing investments for people, we use a blend of these things. We don't think that there is a superior way to do it. We kind of cut it down the middle and let everything work itself out. So the first piece is value versus growth. You'll hear that a lot if you're reading any market news over the last year. You're hearing about this shift from growth to value. So let me start first with what a growth investment is. And I'm referring to stocks. So when we're buying equity in a company, that would be owning a stock. So a growth stock is typically one that we think of as not paying a dividend, where we're buying it just for the capital appreciation. So we buy Uncle Ed's donut shop down the street. We pay $10,000. We want to see that company turn around and sell for $1 million down the road, and we get paid, $150,000. They're not going to pay us any dividends along the way. So that would be a growth stock. In the real world, we tend to think of like Apple would be classified still as a growth stock. What do you got?
I mean, think tech stocks for the most part.
Yeah.
Any
Nvidia,
tech, anything
Snowflake.
that's software as a service, anything that is dependent on growing revenue to grow as a company, to add subscribers, those kind of.
So
that's going to be
and they're dumping money back into their company. They're not paying us to own them. So that's a growth stock. A value stock on the flip side of the coin is a company that's been around since the earth was flat. They're paying dividends. They typically increase those dividends. I always think of like AT&T, Procter and Gamble, Exxon, so some of the oil and gas, Coca-Cola,
Johnson
Pepsi.
Johnson, yeah.
So companies that have been around. Your grandpa probably bought these stocks, and if they held on to them and gave them to you, you're pretty pumped about it. So those are the two styles. So when we're investing now, we split it down the middle. We use both, and when we use mutual funds, which own a pot of these investments, we even have mutual funds that are a blend of the two. So they're kind of going down the middle themselves. So our goal is really to create, I'm talking about mostly US stocks. We're dividing that right down the middle. We want to own half value, half growth. That creates a nice blend for us. Our goal is to kind of try and smooth out as much as we can in that space. So we want to draw a line through the middle of this. We want to draw a line right through the middle and take what we need from it. The other side of the coin is we have these, so we typically buy funds. So when we're managing investments, we're not doing a whole lot of stock picking. It's not really our game. We don't really have the time to do it. And it's kind of an expensive hobby for us to do for you and for you to do yourselves. It's just kind of an expensive full-time job. So we buy funds. So there's two different styles of funds on, again, keeping this pretty high level, but there's active management and there's passive management. And you'll hear this too if you read on stuff. An active fund would be a mutual fund, typically. A passive fund would be like an index fund or an ETF, which they're pretty much the same thing. An exchange traded fund and an index fund, same concept. So why is a mutual fund or an active fund active? So what happens there is you have a team of anywhere from 1 to maybe 6 people that have a history of trading, and they have a nice background in the industry. They buy and sell every day. They're in there every single day, pretty much buying and selling and trying to get you max returns, and they're charging us for that. It's a little bit more expensive. I think our average is somewhere between 1 and 1.5%. They go all the way up to 3%. I think they max it at 3%. So it can be a little bit more expensive way to do it. If we're buying those funds, we're looking at the bottom line. We want to maximize that. On the flip side of the coin, we've got passive funds. So index funds are driven by formula. So nobody is sitting there managing these things. They'll typically update maybe every quarter, once a year. I think of like QQQ is the top 60 cap weighted stocks in the NASDAQ. It's formula driven, and it might update once a year and say, okay, what are the top 60 now? Boom, that's what you got. Okay. They barely charge us to own those. So again, we split it right down the middle. We're using half active, half passive, only in the US space. When we start getting into more complex investing like international, emerging markets, even mid cap, small cap, we are typically using active there because they just outperform. We're just looking at the performance piece. So we, again, we kind of use everything. We use value and growth, pretty much split down the middle in our large cap US. Active versus passive, we split it down the middle as well. So when we're showing people how to invest, we kind of like to use everything. So that's it on that piece. If you have questions about that or want more detail on that, message us, email either one of us, and we'll be happy to dive in further with you on that. Most of you are familiar with our process, but thought that'd be educational because you're hearing those terms a lot right now. And we want you to know that we're using all of them. We're really not playing favorites. So at the end of the day, we want to get you from point A to point B to point C. And we're going to pick the investments that do that the best and keep the most money in your pocket. So, all right. So I'm going to jump into a tip here. So there's actually a book on this. And if you want a copy, reach out to us. I'd be happy to send you one. But it's called Just Keep Buying. But it's more of a philosophy, right? So, and I'll caveat this by saying that this is really geared towards people that are on the pre-retirement side. For our post-retirement folks, we are just recommending you sit tight, try and reduce spending where you can. But for our pre-retirees, we've got a different story. So I'm going to let Cam jump in there.
And this applies to everybody, just in sort of different ways. Like you said, the book was called Just Keep Buying. It's a great title. I think it's probably sort of puts most people's investment strategies in play. Like that is what it is. If you are working at a company and you have a 401k every 2 weeks, you just keep buying. You're not necessarily making a choice to do it. It's just happening. But ultimately, it's by far the biggest tool you have when it comes to growing your wealth and building your wealth. And so for somebody that is working, some of our best clients, they put in money every month, regardless of where the market is. They don't ask if we're at highs, we're at lows. Frankly, if we're at lows, that's better because you're buying at a discount. And that's where the psychology of it becomes a little tricky. Humans are not really designed to be very good investors because when the prices are up, we want to buy. And when the prices are down, we want to sell. The reverse is what we should be doing, which is why oftentimes the mantra of just keep buying is actually the most beneficial. Because then when things are down, you're buying them on sale. When they're up, you're playing the momentum game and you're still going to compound your wealth there. For people that are retired or in a situation where they're not adding to their accounts. So whether it's an old 401k that you rolled over and you don't touch anymore, or whether it's, any kind of account that's not being added to intentionally. One way to think of it is you are still buying because every month or every quarter, when your stocks pay dividends, when your value stocks pay dividends, when your bonds pay coupons, all of that gets reinvested at whatever price the market is at. So again, it's not necessarily the most comfortable way to think about it, but as you're getting these dividends and coupons while the market's down, you're still buying incrementally in at this lower price. And therefore, when the market rebounds, you have more invested at that price. So ultimately, everybody just keeps buying, whether they're doing it intentionally or they're just staying invested. But at the end of the day, that's the most important piece of not trying to time the market and sell when we go through a year like we did. Because if you had gotten through last year and you made it all the way to October and then you couldn't take it, you sold. Well, so far you would have sold at the bottom and you would have missed the 10 or 12% or so we've seen in the fourth quarter and now the first part of this year, where you are starting to head back up as far as stock prices go. And so just not selling, I guess, would be the flip side of just keep buying. But it's kind of two sides of the same coin, where ultimately the long game is what's important. And the fastest way to grow that wealth and build that wealth is to just keep buying or to not sell. That's kind of, just keep buying.
I think one of the biggest messages I got that I read was a quote from Warren Buffett, and I'm just going to paraphrase it because I don't remember the quote, but it's essentially, don't worry about the day-to-day moves of the market. We've got people that do that for us. You go live life, you take what you need from your accounts when you need it, but don't worry about the day-to-day moves. The market's going to do what the markets are going to do. So we'll wrap up here. We've got a couple questions that we will answer. If you have any more, shoot those forward. I don't see any right now, so we've just got a couple here, and then we'll sign off. So this was a good question that came up last time. It's, Cam, if we go into a recession, what will that look like? I mean, I don't mean from like necessarily the investments, but what will that look like? How will we know that we're in a recession, and what will that mean? Like,
Yeah, I
it's been a
mean,
while.
it has been a while, and it's an interesting question because I think everybody last year, 2020, we had 2 quarters of negative GDP growth in a row. Some people would say that's a recession in very textbook terms, that was a recession. Well, technically, the National Bureau of Economic Research, NBER, who hindsight decides when and if we are ever in a recession, has so far not stated that that was enough because employment was so strong. So I think the biggest thing from a standard recession that we have missed so far, and this is why the Fed is so caught up in the unemployment rate, is unemployment and the fact that at this point nobody's losing a job that doesn't want to lose a job. Now there are outliers. Obviously, there are people that have lost jobs, and it's not any better for those people. Like, this is not in any way fix that issue. Microsoft came out today and they're going to lay off 10,000 engineers. So all of those people will be looking for jobs. But that's the biggest piece that has been missing from a standard recession. Generally, unemployment climbs 4, 5, 6, 7%. In something like 2008, you're looking at double digits. For a very short time in 2020, we were in the double digits. And so the Fed has two mandates. They want full employment and they want to keep inflation low. Well, they've been super focused in on the inflation piece up until now, where they're rising rates. As that starts to take effect, and it may take longer even once they've stopped, then we'll see what happens to the overall employment picture. But at 3.5% nationwide, that's historically low. And we're still seeing, 200,000 people getting hired each month, which is not the 400 or 600 we were seeing, a year ago, but it's still a steady state of employment. The thing that doesn't get talked about a lot, I think, is, through the pandemic, both from COVID deaths and early retirement, and there was just a big chunk of the workforce that retired, stopped working, and is not coming back. Couple that with the basic lack of immigration over the last 3 years, and there are less people working now than there were. And so some of these statistics are getting a little skewed, but I think at very broad strokes, inflation has gone up. If we see negative GDP again, then likely it's going to be coupled with at least some rise in the unemployment rate. The estimates I've seen from economists now, if we do hit a recession, it sounds like it's going to be a shallow recession, which I think is where both of us are kind of landing. So maybe you see unemployment up to 4.5%. But something's going to have to change dramatically to make it sort of more projected than that.
Yeah. So to me, it sounds like, ultimately you might know someone that was the job, would be what that, would feel like. There'd be a good chance that, one of your kids or someone, loses a job. I didn't hear Cameron say anything about foreclosures and abandoned houses and people burning buildings down. So
Yeah.
I think it'll be, you won't really know unless we're telling you, unless we're saying, oh, by the way, we went through a recession.
Yeah. There's an old adage that a recession is when your neighbor or friend loses their job, and a depression is when you lose your job.
Right.
We'll see.
Yeah.
But
So probably not what we saw the last time around. Is if we do go into recession, it's going to look and feel different. We know that the market has already priced in some sort of recession. We're still there. So, I mean, we're close to it. So,
yeah.
So we'll see what the market sniffs out. So that actually leads into my question that I was going to answer, which is, when will the markets recover? And it's a crystal ball question, right? I get it quite a bit, and we don't know. We'd love to like put a forecast on it and say, oh yeah, you'll be back at your highs by the end of 2023, but we can't do that. That wouldn't be fair to you, wouldn't be fair to us. And to be honest, we don't know. What we do know is that the market is probably going to stay close to where it's at, without any big improvement until the Fed is done tightening. Once the Fed is done tightening, which we don't totally know when that is either, I believe that the market will assess where we're at as far as the economy goes, and then decide what to do. Remember, the market is going to be ahead of what the economy actually does. So if the market thinks that the economy is going to be go into like a shallow recession or something that's not going to last very long, you're going to see the market run. So we'll see. We have to be patient with it. The nice thing is that, let's see, year to date, we're seeing things up pretty good, actually already. And then Q4, we saw quite a bit of good traction. So as you're getting our reviews from us, you're hearing Q4 numbers and year to date numbers. We are cherry picking. We are looking for some silver lining in this thing because we know how tough this is emotionally, but we are seeing some really good traction lately. So gives us a little breathing room, and we'll see what happens. So that's it for today. I don't see any other questions, so we'll wrap it up until next time. So next month, February, we will have another town hall. Go live your dreams, keep buying, and let us stress about the money. All right. Take care, everyone. Drive safe out there if you're driving.
Be safe.